Imagine lying on an operating table and the anesthesia is just starting to take effect.
Yeah, you got that fuzzy feeling.
Right, exactly. You look up and you realize the entity holding the bone saw, the thing about to physically cut into your leg, isn't a human surgeon at all.
It's an autonomous robot.
It is. And now imagine that exact robot is being financed by, well, the numbers on a corporate spreadsheet that was just released this morning, because that is where we're starting today.
Yeah, we're looking at Zimmer Biomet's Q1 2026 earnings report, along with, a stack of recent medical journals and industry research.
And when we fed all of that into our deep dive analysis today, we didn't just find a dry wall of numbers. We found a literal blueprint for a sci-fi reality happening right now in operating rooms around the world. And we are going to translate it.
It's really wild. To appreciate the scale of this transition, you really have to look at the DNA of the company we're analyzing. Zimmer Biomet is a 90-plus-year-old global medical technology giant.
Right, they're the traditional titans of joint replacements.
Exactly. If someone you know has an artificial hip or knee, there's a very high probability it's a piece of metal and plastic manufactured by Zimmer Biomet.
But looking at the sources we've gathered, this first quarter report proves they are rapidly shedding that traditional hardware identity.
Oh, absolutely. They are transforming into this massive digital AI and data-driven ecosystem.
Okay, let's unpack this. Because the transition to all this tech is expensive.
Yeah.
And it all starts with the headline numbers that Wall Street reacts to first. First quarter net sales hit a massive $2.087 billion.
With a B. No.
With a B. And the top line growth looks incredibly strong. They reported a 9.3% increase in sales compared to the same time last year. But here's the thing about financial disclosures. They always require a little bit of translation.
They definitely do. You have to read the fine print.
Right, because when I was looking through the revenue tables, I noticed a major discrepancy. They boast about this 9.3% reported growth, but then, like 2 columns over, there's a line for organic constant currency right next to it.
And that number is drastically different.
It's only 2.9%. Looking at this, to me, feels a bit like stepping on scale while wearing a really heavy backpack. You might weigh a lot more, but you didn't actually grow that much muscle. Why does that impressive 9.3% suddenly shrink down to 2.9%?
Well, what's fascinating here is that your backpack analogy perfectly captures the mechanics of corporate acquisitions. When a business talks about reported growth, they're simply counting the total cash register receipts this quarter versus the same quarter last year.
Regardless of where the receipts came from.
Exactly. And a company's sales can increase for reasons that have literally nothing to do with selling more of their original products. Foreign currency exchange rates provided a minor boost this quarter, but the really heavy item inside that backpack is the acquisition of a company called Paragon 28.
Right, which Zimmer Biomet bought back in April 2025.
Correct. So by purchasing Paragon 28, they essentially bought all of Paragon 28's existing sales and just piled them onto their own balance sheet.
That is the ultimate strategy behind buying growth. If you acquire a successful business, your overall revenue jumps on paper simply because you've absorbed their revenue streams.
Yeah, but organic growth asks a much tougher question. It asks, if we strip away the effects of fluctuating international currencies, and if we pretend we never even bought Paragon 28, how much did our underlying homegrown business actually grow?
And that is where you get the 2.9% figure.
Exactly. And there's a specific category in this report that provides a perfect case study for this dynamic. It's their SET category.
I saw that acronym. It stands for Sports Medicine, Extremities, Trauma, Craniomaxillofacial, and Thoracic.
A very long name for a vital part of the business. In the first quarter of 2026, the SET category skyrocketed by 19.5% on a reported basis.
Which is huge. If you just look at that top number, you'd assume their sales team suddenly became superhuman.
Right, but Paragon 28 specializes in foot and ankle orthopedic solutions. They make things like the Phantom Curved TTC nail system, which is used for hindfoot fusion procedures.
And that's where surgeons literally fuse bones in the back of the foot together to stop severe arthritis pain, right?
Yeah, it's an intense procedure. And all of those sales fall squarely into this SET category. So when you calculate the organic growth, removing the entire Paragon 28 acquisition from the math, that massive 19.5% growth plummets to just 1.6%.
Wow, so 19.5 down to 1.6. That perfectly illustrates how an acquisition can kind of mask the performance of the core products.
It does, and it's not necessarily a bad thing. They deployed capital to buy a great asset that's bringing in real money.
Right. But as someone trying to evaluate the actual health of the business, you absolutely have to separate the acquired muscle from the organic muscle.
For sure. The math basically shows that management is aggressively using their cash to buy their way into strategic high-growth markets like foot and ankle surgery.
While the underlying engine of their legacy business is moving at a much more modest, steady pace of 2.9% globally.
All right.
Understanding that dynamic completely shifts how we have to look at their product pipeline. If the headline numbers are inflated by acquisitions, we need to know what is actually driving that organic, homegrown success. Like,
Yeah.
what are they selling that hospitals are actually buying?
Let's move away from the spreadsheets for a second and step back into the operating room. A great place to start is with the foundational products.
The legacy stuff.
Right. Looking at the category sales, traditional knees brought in $828.6 million, growing 1.8% organically. Hips brought in $524.1 million, growing 3.2% organically. These are the historic cash cows.
But the clinical research we pulled alongside this report proves they aren't just selling standard metal joints anymore. This is where the sci-fi element kicks in.
Oh, absolutely.
I was reading the recent highlights section, and they mention a system called UMBUS. The report describes it as a first-of-its-kind, surgeon-guided, autonomous, robotic, total knee arthroplasty system.
Quite a mouthful.
Yeah. Now, I'm assuming total knee arthroplasty is just the medical phrasing for a full knee replacement where they cut away the damaged bone and cap it with metal and plastic.
That is the exact procedure, yeah.
Okay, so I want to ask you, listening to this right now, a question. Imagine going in for that surgery. Your knee is going to be completely reconstructed. How do you feel knowing an autonomous robot is doing the work?
It's a heavy thought for a lot of people.
It really is. I mean, I'm genuinely trying to wrap my head around the word autonomous here because
Yeah.
we've had robotic-assisted surgery for years,
Yeah.
right? But usually that just means the human surgeon is physically holding the tool.
Yeah, and the robot is basically acting like a smart bumper, keeping their hand from slipping out of a safe zone.
Right, like bowling with the bumpers up.
Yeah.
So how is this new IMBO system actually functioning in the room?
Well, the word autonomous represents a massive leap forward in surgical mechanics. The IMBO system, which Zimmer Biomet acquired from Monogram Technologies, shifts that entire paradigm. The robot is actually capable of executing the bone cuts itself based on a highly detailed 3D model of the patient's specific anatomy.
Wait, so the robot is independently moving the blade?
Under the strict guidance and oversight of the surgeon, yes. The system actively tracks the patient's bone in real time.
So if the patient's leg shifts slightly, or I don't know, even if they just breathe heavily?
The cameras track that movement in three-dimensional space at incredible speeds, and the robotic arm adjusts its cutting path instantaneously. The surgeon is the architect and the supervisor, but the machine is executing the physical labor of the cut.
That is wild. On one hand, you obviously want the precision of a machine that doesn't have a human hand trimmer, but on the other hand, trusting a robot with a bone saw is a huge psychological leap for a patient.
It's a profound psychological shift. But from a clinical perspective, it is the holy grail. Think about the mechanics of a knee replacement. If an implant is misaligned by even a single millimeter or a few degrees, it can wear out years earlier than it should.
Which causes pain and requires a second, much more complicated revision surgery.
Exactly. Autonomous execution removes the variability of human fatigue. Better micromillimeter precision means implants last longer, recovery times are often faster because there's less collateral tissue damage, and hospital outcomes improve.
And UMBOs isn't an isolated project. They are aggressively pushing software and robotics across the board. The research notes they just launched the RS and knee system with optimized software at the 2026 AAOS meeting.
Right, and from what we can tell, that isn't even about the cutting, it's about the workflow.
Yeah, the software predicts what tools the surgical staff will need before they even ask for them, which shaves minutes off the procedure time.
Time is the most expensive commodity in an operating room. If software can optimize the surgical workflow so seamlessly that a hospital can safely fit one extra joint replacement into their daily schedule, that software pays for itself incredibly fast.
But building autonomous robots and predictive software requires a totally different DNA than manufacturing titanium joints. You can't just hand that task to a traditional orthopedic engineer.
No, you definitely can't.
That's why I was looking closely at who is actually running this new tech division. The report highlights the appointment of Dr. Jonathan M. Vigdorchik as the new Chief Science, Technology, and Medical Affairs Officer.
His mandate is probably the most telling part of this whole transition. He isn't just overseeing scalpels, screws, and standard implants.
Mm.
The documentation specifically notes that he is overseeing the global end-to-end technology portfolio.
Which explicitly includes AI, robotics, data, and, quote, smart implants. I have to admit, I'm a skeptical when I see lists like that. Every company right now slaps AI and smart onto their investor decks because they know the algorithms will pick it up and juice the stock price.
Oh, for sure. It sounds great on a financial news segment.
Right. So what does this all mean? Is this just corporate buzzword bingo, or is there actual proof in this report that they are executing this vision and making real money off this data ecosystem? Or are these just giant R&D money pits?
The skepticism is absolutely warranted, but the proof of execution is buried in the revenue breakdown. Take a look at the product category labeled Technology and Data, Bone Cement and Surgical. That specific category generated $171.8 million in the first quarter.
Okay, now compared to the $828 million from traditional knees, it seems small.
It does, but look at the trajectory. That category grew by 14.6% on a reported basis and 11.7% organically. It is by far their fastest growing organic segment. Hospitals are actively writing checks for their technology and data platforms.
Okay, yeah, that 11.7% organic growth is hard to argue with. They are clearly monetizing the tech. But let's look at one of those buzzwords Dr. Vigdorchik is managing, smart implants. How exactly does a hunk of metal and plastic inside a human knee become smart?
It comes down to embedding microsensors directly into the structural components of the implant itself. Instead of just being a passive shock absorber, a smart implant acts as a biomechanical data gatherer.
So these sensors can measure load, pressure, and the kinetic movement of your specific gait.
Exactly.
Wait, how are they powered? You can't exactly go in and change a AAA battery in someone's femur.
No, you definitely can't. The most advanced designs use passive RFID technology, similar to how you tap a credit card, or they actually harvest kinetic energy from the movement of the joint itself.
Oh, wow.
Yeah, they gather data on how much weight you're putting on the leg, whether you're limping, your range of motion, and even subtle temperature changes. All of that data is transmitted wirelessly to a base station in the patient's home and then uploaded to the cloud for the surgeon to review.
That fundamentally changes the business model. A modern medical device company suddenly needs a data architecture just as robust as a traditional tech company like Google or Apple.
It's a huge shift.
If you are putting millions of implants into people, and those implants are streaming data about how human beings walk, recover, and put stress on their joints, you are sitting on a gold mine of biometric information. They can use that exact data to design the next generation of physical implants.
It creates a closed-loop ecosystem. The physical hardware generates the data, the AI analyzes the data to improve the surgical robotics, and the robotics implant the next generation of hardware more precisely.
But building that ecosystem is unbelievably capital intensive. They are incurring heavy upfront costs to build out server infrastructures, acquire companies like Monogram Technologies, and fund clinical trials.
Wow.
All of this futuristic tech requires an astronomical amount of cash to develop.
So let's look at where that cash is coming from today. When you dig into the financial fine print of this earnings report, the profit numbers are fascinating, but they're also deeply confusing. There's a massive gap in how they report their earnings per share, or EPS.
The classic GAAP versus non-GAAP reporting discrepancy.
Yes, and the gap here is huge. The report states their diluted earnings per share was $1.22, which is up a very respectable 34.1% from last year. But right next to it, they highlight an adjusted diluted earnings per share of $2.09.
That's almost a whole dollar difference per share.
Exactly. When you have roughly 195 million shares outstanding, we are talking about hundreds of millions of dollars in difference. How does a company legally publish two vastly different profit numbers in the exact same press release?
Well, it is the tension between the strict rules of accounting and the messy reality of running a sprawling, evolving business. GAAP stands for Generally Accepted Accounting Principles. It's the standardized, inflexible rule book that every public company must follow so investors can compare apples to apples.
Right, so nobody can hide the ball.
Exactly. Under GAAP, you have to include every single expense on the balance sheet, even if it is a bizarre one-time event that has absolutely nothing to do with your day-to-day operations of selling surgical robots. So the $22 figure is the strict, legally mandated GAAP number.
But corporate management teams always argue that GAAP doesn't tell the real story of how the underlying business is actually performing, right?
They do. They argue GAAP obscures the daily operational health. So they provide non-GAAP or adjusted figures. They are essentially telling the market, hey, if you want to know how our core business of selling joints and software is functioning this quarter, ignore these specific one-time accounting charges.
Got it. So Zimmer Biomet excluded several massive items to build a bridge from that strict $22 up to their preferred $2.09 adjusted number.
Yes, they did.
Let's look at those exclusions because they really explain the mechanics of how massive corporations operate. The biggest exclusion I saw in the reconciliation tables was intangible asset amortization, which accounted for $162.1 million.
Right, because when Zimmer Biomet buys a company like Paragon 28, they aren't just buying physical factories and boxes of screws. They are buying patents, brand recognition, and established customer relationships.
The intangibles.
Exactly. In the accounting world, these are known as intangible assets. The GAAP rules force the company to slowly expense the theoretical value of those intangibles over many years, which drags down their official profit every single quarter.
But management argues that this isn't a cash expense they are writing a physical check for today.
Right. It's just an accounting math penalty from past acquisitions, so they remove it to show you their real operating profit.
Okay, that makes total logical sense. But then I saw another exclusion that sounded incredibly dense. An inventory step-up expense for $12.0 million. What on earth is an inventory step-up?
This is one of the strangest quirks of acquisition accounting. When you buy another company, the rules say you have to revalue their existing warehouse inventory at fair market value, rather than what it originally cost that company to manufacture.
Okay.
So when Zimmer Biomet eventually sells that acquired inventory to a hospital, their profit margin looks artificially tiny because the cost of the item was stepped up on paper during the acquisition.
Oh, I see.
By excluding that $12 million, Zimmer Biomet is trying to show investors what their profit margins would have been if they had manufactured the items themselves at their normal lower costs.
So it's essentially like buying a house that comes with a bunch of furniture already inside. You reappraise the furniture at a much higher price for the mortgage, and then when you sell the couch at a yard sale, you complain that you didn't make much profit because the appraised cost was so high.
That is a brilliant way to visualize it. You are adjusting the math to reflect the reality of the cash register.
That makes perfect sense.
They also excluded restructuring programs and integration costs.
All right.
Remember, Zimmer Biomet recently spun off their entire dental and spine business into a separate independent company called ZimV Inc.
Right, so they are still paying lawyers and consultants to untangle lingering post-separation costs from that move.
Exactly. Throw in a $12.1 million one-time benefit related to Swiss tax reform, and you suddenly bridge the gap from $1.22 to $2.09.
So here's where it gets really interesting. If you are trying to evaluate this business, you really have to make a philosophical choice. Do you believe the adjusted story, which claims these are just temporary bumps in the road and the real profit engine is humming along at $2.09 per share?
Right.
Or do you look at the strict GAAP story of $1.22, which argues that constant acquisitions, corporate restructuring, and global taxes are just the messy, unavoidable realities of running a modern empire, and therefore they should be counted?
Well, the market tends to focus heavily on the adjusted numbers because they serve as a better predictor of future cash flow once the temporary dust settles. And looking at the forward guidance, Zimmer Biomet's CEO, Ivan Tornos, is projecting massive confidence in that underlying cash flow.
He raised the guidance, right?
He did. Based on the strength of this Q1 performance, he actually raised the full year 2026 adjusted EPS guidance. They are now projecting $8.40 to $8.55 for the year.
And the most important metric of all, they generated $245.9 million in free cash flow just in this first quarter alone.
Which is huge.
It's a massive amount of unencumbered cash to keep pouring into the robotic and AI future we explored earlier.
They aren't just surviving the transition. They are actively financing their own evolution. They are utilizing steady cash flows from traditional metal knees and hips to fundamentally reshape their identity into a digital healthcare leader.
So when you pull all of these sources together, the 9.3% reported growth fueled by the Paragon 28 acquisition, the 11.7% organic surge in data tech, the leap into autonomous surgical robotics with the UMBO system, And the appointment of Dr. Vigdorchik to architect an ecosystem of smart implants, it is clear Zimmer Biomet is playing a very long, very high-tech game.
And this matters to you, the listener, regardless of your background. If you are an investor, this report is a masterclass in looking past headline numbers to find the true story of organic growth and acquisition strategy.
Yeah, and if you are a business professional, it demonstrates how to pivot a legacy brand's entire identity using targeted capital allocation.
But most importantly, if you are simply a human being who might need joint surgery one day, this analysis proves that the intersection of autonomous robotics, cloud data, and your biology is no longer a concept for the distant future. It is the current reality of modern medicine.
The operating room of tomorrow is literally being financed by the earnings reports of today. But as we wrap up, I want to leave you with a final thought to mull over. We spent a lot of time breaking down Dr. Vigdorchik's mandate for smart implants and AI analytics.
Yeah, the biosensors.
Exactly. If our joint replacements are becoming physical sensors, if they are permanently inside our bodies, gathering microscopic data on our gait, the stress on our bones and our daily movements, and then transmitting that data back to a corporate server who ultimately owns the copyright to the data of your own walking habits.
That is a fascinating question.
As our physical bodies merge with this technology, the lines between our biology and corporate intellectual property are going to blur in ways we haven't even begun to legislate. Thank you for joining us on this deep dive, and as always, keep questioning the numbers behind the news.